This is Before and After from Refinitiv. I'm your host, Johanna Botta. 2020 could be the year that the corporate fairy tale that has carried the U.S. economy hands over the baton to that old pillar, housing. 2019 ended with clear momentum in U.S. housing figures, and the last report, which detailed November's numbers, indicated a double-digit year-over-year growth, with house hunters having been energized by mortgage rates that are at a near three-year low at under 4%, and a tight job market helping would-be owners qualify for a mortgage. Construction has been much stronger than a year ago, when we were a good 50 basis points higher on average 30-year rates. The Atlanta Fed has residential investments slated at 3.9% growth for the fourth quarter, after 4.6% the previous quarter. These were the best back-to-back quarters since 2016-2017. Bottom line, it feels like we've seen this movie before. With everyone focused on non-asymmetrical risks in the stock market, will housing get shaky again? With 4% of the GDP accounted for in residential housing and another 12.5% of GDP in housing and utility services, we do need to pay close attention. Expectations are for 728,000 new home sales for the month of December, a lofty number if judged by the last 10 years. And it's no surprise that the housing index in the U.S. has surged on the strong fundamentals. Consider Lennar, the second largest holding at 4.65% in the XHB, which is the home builder ETF. The stock price has reflected the moves in new home sales. Priced in the low 60s at the time of this recording, Lennar is still 10% off the highs made in early 2018, while new home sales are at their highest level since 2007. Needless to say, Lennar, which is off to a great start this year, is up 13%, making it the second best XHB ETF, and definitely one to watch. A strong number followed by selling in Lennar could mean a short-term top has been made in the index. On the other hand, a weak number, under the expected 728,000, and you'd expect to see Lennar go down sharply on the day. Strength in both scenarios means this stock will be a market leader for the first quarter of 2020. But under 60 on Lennar as an instant reaction could accelerate selling in the intermediate term. Otherwise, expect Lennar to set sights on the highs of 71.82 made almost exactly a year ago. One area of the economy that needs to show improvement in 2020 is manufacturing. This is true worldwide, but in the US, it represents the missing piece for the bullish economy case. Expectations are for the PMI reading to come in at 52.5, in line with the prior month, and above the 50 level, which indicates that the economy is still growing. The last reading in December showed an uptick in the year ending strong after a mid-year slump. And though the numbers were stronger, there was a lingering cautious tone due to geopolitical instability. Like many other economic conditions and the stock market, one would never assume that the U.S. manufacturing powerhouse, Honeywell, would be trading at all-time highs. But such is a strange contrast of 2020. Honeywell is involved in such a broad suite of products and industries that it makes the company an interesting bellwether for U.S. manufacturing. From jet engines to footwear, Honeywell manufactures just about everything. Honeywell should then be a stock to watch on the back of the market manufacturing PMI. The bottom line, Honeywell is trading at an expanded price earnings of over 20, which is in line with a multiple expansion of the broader S&P. But we need to see growth beginning before it picks back up. The key question is, will economic reality jump up and trend towards what Honeywell's stock price is screaming? Or, as resilient as the U.S. economy appears to be, will the stock come back to the reality that manufacturing remains vulnerable? Let's look at where Honeywell stock traded last summer, when the manufacturing PMI was making year lows right above the 50 mark. The stock has rallied 18% since then, while the manufacturing numbers have only marginally improved. The risk in the short run is to the downside, the caveat being that PMI comes in super strong. So, Netflix beat their earnings per share estimate by a lot, coming in at 1.30 versus estimates of 0.53. This was also significantly better than their EPS for this quarter last year, which came in at 0.3. And they slightly beat the revenue estimates of $5.45 billion, getting $5.47 billion. The stock sold off 2% in the after-hours reaction, quickly traded back to unchanged, but then underperformed a falling market on Thursday, perhaps giving us a glimpse of how the stock will trade over the coming days. But nevertheless, it was all about the subscriber numbers. Netflix only added 420,000 US subscribers versus the expected 659,000. And more importantly, Netflix also revised down first quarter subs lower to 7 million new subscribers versus what was expected to be 7.82 million. All in all, a mixed report. It's good to see the company achieving earnings targets, but could competition be slicing up the pie? We'll just need to wait and see. There it is, U.S. new home sales and market manufacturing data in the before, Netflix, and the after. Refinitiv data throughout. This has been the Friday episode of Before and After. Please subscribe and then hit that notification bell to ensure that you're alerted to all of Refinitiv's future market updates.